How to calculate the probability of profit using the options chain. Have you ever wondered how traders figure out the chances of making money with options? Today, we will break down how to calculate the probability of profit using the options chain. This is a key skill for anyone interested in options trading, especially when looking for swing trading opportunities. First, you need to identify the specific option contract you want to analyze. Look at the options chain and note the strike price and expiration date. The expiration date is important because it affects the probability calculations based on the time left until the option expires. Next, let's talk about delta. Delta is a metric that shows how much an options price is expected to move with a $1 change in the underlying stock. You can use delta as a rough estimate of the probability that the option will finish into money. For example, if a call option has a delta of 0.3, it suggests there is about a 30% chance it will expire into money. On the flip side, the chance of it expiring out of the money is roughly 1 minus delta, which in this case would be 70%. If your trading platform has a probability into money column, that can be very helpful. This number tells you the calculated chance that the option will be into money at expiration. For instance, if a call option shows a 21% probability into money, it implies a 79% chance it will expire worthless. This could mean a 79% probability of profit for someone selling that call option. Another important aspect is to consider the range of prices and the probability distribution. Some platforms provide advanced views that show the likelihood of the underlying stock staying within certain price ranges by expiration. For example, you might see a 37% chance that the stock stays between two specific strike prices. This information is useful for traders who want to understand the likelihood of profit for spread strategies or defined risk trades. To calculate profit thresholds, you need to know the strike price and the premium paid or received. Profit occurs if the stock price at expiration is favorable compared to the strike price plus or minus the premium. For a call buyer, profit happens if the stock price exceeds the strike price plus the premium paid. For a put buyer, profit occurs if the stock price falls below the strike price minus the premium paid. Knowing these break-even points helps you define the price range where profit is possible. Many traders also use option probability calculators or tools available on their trading platforms. These tools estimate the probability of profit by considering the underlying asset's price, volatility, time to expiration, and risk-free interest rate. They often use models like Black-Scholes to generate probability curves. It is also essential to adjust your calculations based on your trading strategy. The probability of profit can vary significantly depending on whether you are buying or selling options or using spreads. For example, buying a naked option might have a lower probability of profit, typically around 30 to 50%. In contrast, selling options or using spreads can increase the probability of profit by collecting premium and defining risk. When you are identifying swing trading opportunities, use the options chain to find options with a favorable probability of profit that aligns with your market outlook and time frame. Look for options with high probability into money or delta values to select strike prices that offer a strong likelihood of profit within your expected price move. By monitoring how probabilities change as the stock price moves or as expiration approaches, you can adjust your trades accordingly. This approach helps you make informed decisions and increases your chances of success in options trading.